Good morning from London. I'm Kriti Gupta alongside Johnson and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. Negotiations about Ukrainian territory may be on the table ahead of this week's U.S.-Russia summit. That's according to NATO Secretary General Mark Rutte, despite pushback from President Zelenskiy and other European leaders. And we are less than 24 hours away from the expiry of the U.S.-China trade truce. President Trump urging China to step up purchases of American soybeans, a pillar of his deal with Beijing in his first term. And sticking on the trade front, Nvidia and AMD agreeing to pay 15% of their revenues from Chinese AI chip sales to the U.S. government. In a deal to secure export licenses, it marks an unusual arrangement that could unnerve U.S. companies operating abroad. Valerie.
We have an hour to go into the first cash equity trade here in Europe, and we are trading quite positive risk-on sentiment across the cross-asset picture. We have S&P futures, Euro Stoxx 50 futures in the green. The dollar is a bit softer, and U.S. 10-year yields have just opened up. They were paused on trading as Japan was off for a holiday. Yields are 2 basis points lower. The countdown to the opening trade starts right now.
Monday morning, good morning. Prepare for a week of questions. Whether or not we get any answers remains to be seen. But there's a lot on the agenda this week, despite the fact that we are now deep into August and Europe basically has shut down. We're waiting to see what comes out of the meeting in Alaska later on this week. Tomorrow, we get CPI data. We'll chat about all of that. We've got to fold in also what's going on with Nvidia as well this morning. I'm confused about all of this. I don't have answers to many of the questions that have been thrown around the newsroom this morning, but there's plenty to debate. We should kick off and talk a little bit about this Alaska meeting that is coming up at the back end of the week. We can debate kind of what happens on the geopolitical front. What I think we probably should do first thing this morning is think about what it does to European markets. I noticed that Hensoldt is already down sharply on Tradegate this morning. One of the defence companies, Rheinmetall, I know I wasn't here last week, fell sharply on the back of its earnings. Why is the euro not moving on the back of this? Do I buy concrete companies? Anna should be here. We could talk about that and the fact that concrete companies may get big because there's a lot of reconstruction that could happen. Lots of questions around this, but from a market's perspective, I think it's going to be a really interesting week as everybody jostles kind of around these sort of trades to try and work out whether this is good for Europe or bad for Europe.
Yeah, it's interesting that it seems like geopolitical commentators are less rosy on the outlook of having a breakthrough, but take a look at the oil market, and it's telling you that it is pricing something in already. I mean, Brent crude, since that weak payroll print on Friday, is down nearly 9%. A lot of that price action happened last week. It's continuing it again with oil trading soft, both WTI and Brent slightly in the red this morning. There is some positivity on a breakthrough price into the oil market, and we're seeing that slightly, maybe so slightly, in Euro Stoxx 50 futures at the moment and very slightly in the euro. But I think that goes to show about the question of risk-reward here. If you do want to play for some sort of detente on this U.S.-Russia war, which asset is less underpriced and is not pricing most of that juice in yet?
But that's all on the downside. You mentioned kind of that marginal move in oil as well. I think it could also very quickly, the narrative could shift back to this idea that we had, I want to say a year ago when we were talking about this, or at least a couple months ago, I should say, but also a year ago when we were talking about this idea of a ceasefire. And there was a question here of how much that geopolitical shadow is actually a tailwind for equities. There's another argument here that if you do see some of the momentum pulled out of defense contracts, out of some of the oil story as well, that money can get rerouted into other places, which was, by the way, the bear case of defense to begin with.
Do you sell defence? This is not actually a joke. Do you sell defence and buy concrete? Defence has driven the European story for months now.
Well, look, it doesn't make up a massive portion of the Euro Stoxx 600.
I agree.
So you could argue that European stocks can still rally strongly on any positive news, despite defence taking a back foot.
But to Kriti's point about a zero-sum game, you've had a great run in defence stocks. Do you now look elsewhere? What's the next bid that comes into the Ukraine narrative? Is it the reconstruction trade? Is it steel? Is it what is it that you look at next? For the next sort of leg of this story, have we reached the point where the defence narrative isn't going to go much further? These companies are priced strongly.
Yeah.
Is there another element that's going to come here? And is that what the market's going to think about this week?
It's certainly something that we're going to get some clarity on. There's also a question of does anything even happen if we don't really get any details of it at the end of the day? Because frankly, even to me, this feels like deja vu from a conversation we had a couple of months ago. Another conversation we had a couple months ago that is ongoing is that trade story. We had Scott Bessent, I believe, making some comments to the Nikkei over in Asia, saying that those trade deals should be done by October. He's already also talking about this idea 24 hours ahead of this trade truce expiring with the U.S. and China about increasing the purchases of soybeans from China, which, again, is a bit of deja vu. We've seen this picture before.
Back in 2018,
from
right?
From the farm deal and with Donald Trump's first administration when it comes to China. And at the end of the day, it was agreed upon, and those quotas were never filled.
Deja vu week? Maybe that's going to be the new word?
That could be it, yeah. I'll go with...
We have been here before.
Maybe we already know the answers then. Maybe that's the way to look at this. The October thing, I think, is fascinating. Does that mean the China deal's done by then? Because it doesn't feel like it's going to get done right now.
In the next 24 hours.
Well, precisely. So it doesn't... Are we going to get... And is it the beginning of October, the end of October? This feels really vague to me. In terms of trying to hang your hat on something.
Bessent is positive on trade talks. I guess that's the takeaway.
Well, he thinks they'll be done. Is that positive? I don't know.
Yeah.
Does the Chinese deal get done by then? That would be significant.
Yeah, and to that point, there seems to have been another front to open up on the U.S.-China trade deal having to do with chips. You have Nvidia and AMD both saying that they have agreed to pay the U.S. 15% of these AI China chip sales. Now, this is very confusing on many fronts, but also quite unusual because export taxes really don't have a big precedent in modern corporate history. And then the question is, what is behind this? Why? Is Trump doing this to appease the China hawks in the administration? Or perhaps is this a revenue raiser, to your point?
If you wanted to appease the China hawks, you would say you cannot sell. That would be the way you appease the China hawks.
Needle.
Maybe. Just generating... So the Chinese still get their chips and we get a little bit of money. Does that work? I don't know.
Where does the money go is the other big question.
Where is the money, I think, is the other question.
Well, there's another fear here, which comes back to kind of the deep-seek narrative of the start of the year, which is that if you don't have that dependency on U.S. chips, do you have an actual competitor that is getting motivated? And that was one of the concerns with Biden's export kind of freezes.
And the Chinese are already speaking to that.
Yeah, well, OK, this also comes at some different curious times for many reasons. One of them is because the U.S. just began issuing these H-20 export licenses to Nvidia on Friday. The ones on AMD, they're also working on. So this is maybe coinciding at the same time. Maybe this was all part of the deal to begin with, and Nvidia and AMD already knew that this kind of fee, I don't want to call it a tariff, but this kind of export fee was already going to hit them.
Let me put another theory out there. Maybe he's watching the stock market. Maybe he's watching that Nvidia takes a massive hit every single time these things get frozen, and it makes a good chunk of their revenue at the end of the day. And maybe he's concerned about the stock market.
Maybe he's just watching the stock price soar to the moon and going, I want a bit of that. If you look at the tariff story and think about it, this isn't going to change any of the kind of supply chain story. This doesn't change anything around that. So the whole reshoring story doesn't work along these sort of lines. Is it just simply a revenue-raising exercise? You could argue that a lot of the tariff story has just been about that, just raising revenue.
Maybe all of the above.
I want my slice here.
All of the above.
I think there probably is some truth to that. There probably is a little bit of all of the above. Anyway, lots of questions, and we're going to work our way through to maybe some answers as we get through the show. We've got some great guests to do all of this. Laureline Renaud-Chatelain, Pictet Senior Fixed Income Strategy, is going to be joining us. We'll talk about the inflation story as well, which is going to be very front and centre tomorrow. Ian Harder, Absolute Strategy Research, is going to be joining us a little bit later. He's worried about us being in the 1920s, 1930s. He looks at what's happening with the tariff story. Laura Cooper is going to be joining us, Nuveen Global Investment Strategist, the head of macro credit. And Jane Kinnemont, United Nations Association UK CEO, is going to be joining us later to talk tariffs, to talk what's happening in Ukraine, to talk all of this.
Yeah, and let's set you up for the week ahead because it's one that's focused mostly on U.S. economic data. We get U.S. CPI, PPI, and retail sales all this week. We also get some key data out of the U.K. with the labor market data coming on Tuesday. But this main focus this week for me is on both on CPI. Do we get that kind of tariff-induced inflation? And then with retail sales, is the consumer still strong in the face of tariffs?
Is this stagflation week? I'm going to call it stagflation week, just to annoy Val, mainly.
I'm glad that this is getting directed to you. It used to get directed to me, and I really appreciate some of the pressure getting taken off here. Does CPI tomorrow even matter if the PPI and the retail sales are on Thursday, Friday? Do we just kind of brush off tomorrow's number for later this week?
It is odd to have a day gap in between CPI and PPI, so maybe we'll just have to sit here waiting to hear what these PCE components end up being from the PPI so we can feed it all in.
I think a strong print will scare the market, though. I think it's easier in some ways to react to a strong print from a trader's point of view than a weak print, because then you're looking at trying to understand what is happening how long the effect takes to come through from the tariffs.
But did you listen to what Michelle Bowman said on Saturday? She is essentially wanting to strip out tariff-induced inflation from the CPI and look at everything else. So it's going, maybe we go back to this whole, remember when we had, core services, ex-housing, ex-healthcare, and we were totally crazy about the CPI basket. Maybe you'll have one part of the Fed viewing CPI X tariffs, and then the rest of them just focused on tariff inflation.
But to your point, central banks are deeply divided. You can see it in the Bank of England as well. It's interesting. We're going to get data out of the UK this week as well on the labour front.
Yeah.
Inflation in this country is really high at the moment, and the labour market is very, very weak. You just wonder whether or not that's the narrative that is going to be exported or taken on by the United States.
Same kind of pickle. Do you rescue the labour market and risk a rise in inflation?
But what does scare the market even mean? I mean, you said scare the market. I mean, stocks drop, bonds drop. What happens to the dollar? Is that a good? Is that
scaring
a bad?
the market would be services CPI starting to tick higher on the back of core goods CPI. That would definitely freak the market out. But I don't think we're going to see that.
It's going to take a lot. This is a market that can take some big hits, but we'll see. It's August. Anything can happen. You can either have a crazy August or a quiet August. We don't know which one we're going to get yet. What else you need to know this morning? Let's run you through some of the details. The Israeli Prime Minister, Benjamin Netanyahu, has defended a plan for a further military sweep against Hamas strongholds in Gaza, calling it the best available option for recovering hostages. The Netanyahu government authorized the advance on Gaza City Friday after talks on a third ceasefire stalled last month. The UK jobs market weakened across the board in July as employers cut payroll budgets in response to the government's £26 billion tax increase. The data comes from a survey done by KPMG and the REC, which found that the UK starting salaries have risen at the slowest pace over the last 4 years. The slowdown has also been attributed to increasing number of job seekers chasing fewer vacancies. And lithium prices have spiked after battery giant CATL halted operations at a major mine in China. The move has spurred speculation that Beijing might suspend other projects as it tackles overcapacity across the economy. We're told CATL's mine will be shut for at least 3 months. Lithium prices have already come down pretty sharply.
We're gonna talk about the ripple effects into the European market shortly. But coming up on the program, sources say Nvidia and AMD, they're due to pay 15% of Chinese chip revenue to the U.S. government. We're going to unpack that story and check on the market impact. Plus, Martin Sorrell's S4 Capital has received merger approaches. This, according to Sky News, shares down nearly 60% since last year. It's one of our stocks to watch. But up next, right back to the markets. There's a lot happening this week. We're going to keep an eye on the U.S. inflation print. We're going to dive into what a reaction actually looks like in these markets. Do you have any questions for us or for our guests? Get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg. We are just about under 45 minutes away from the opening trade across Europe. Futures are looking marginally positive. I think, to quote Guy, it could be calm, it could be chaos. That's what an August summer market looks like. Maybe Val can bring us a little bit more in terms of what could give this market some momentum. Val, walk us through it.
Well, I want to bring your attention to Michelle Bowman's speech on Saturday. Remember, she is the Fed governor that dissented at the last meeting, and we had not heard from her since that weak Friday payroll print around a week and a half ago. But honestly, I thought her speech was going to be a bit more juicy than it was. I thought she was really going to be pushing for immediate cuts, but she still favors 3 cuts the remainder of the year. So not intensely ramping up her expectations for the amount of Fed cuts. She is still penciling in 3 on her SEP. That's what she said. She also is reiterating again that there's greater risk to the employment side of the mandate rather than inflation. And when it comes to inflation, she did a very interesting thing where she stripped out tariff-induced inflation from her PCE forecast, which I thought was very telling of what we might see economists do after Tuesday's CPI print, the big data print on the week on Tuesday. There's going to be many different arguments, many different takes from this CPI print. On one hand, you have the likes of Governor Waller, Governor Bowman arguing that the progress on core services, on housing disinflation is the reason why they want to keep cutting. On the more hawkish side of the table, you have the others that might be arguing that this increase in core goods is something they are concerned about. They're concerned about inching in to core services inflation. So keep an eye on how that fleshes out on Tuesday's print. I also do want to note that this drop in oil does play into this CPI narrative as well. In the last 7 days, so since that week payroll print on Friday, Brent crude has dropped now nearly 9%. So this could help out the more dovish members of the FOMC who want to argue that tariff-induced inflation is not something to worry about. You also have this oil taking a back foot, helping those gasoline, those prices at the pump for those U.S. consumers. Guy.
By the end of the week, we might have some answers to what exactly the impact is on that tariff story. Goldman Sachs out with an interesting note talking about the fact that U.S. consumers are the ones that will ultimately end up footing the bill. Laureline Renaud-Chatelain, Senior Fixed Income Strategist at Pictet Wealth Management, joining us from Geneva on this story, setting us up for a week in the bond market. Laureline, good morning. How do I react to a strong CPI print this week? We've been surprised that inflation has not picked up on tariffs. Do we finally see it this week? And how do I position for that?
Hey, good morning. So when we look at the bond market, it's true that post the payroll, a lot of pricing in terms of the rate cut from the Fed has been in the market. So when we look at the Fed funds future, you see that we have a 25 basis point rate cut that is fully priced in now for September. It wasn't the case before the payroll report. So what this CPI could do if it comes very strongly is really reduce this probability of a rate cut in September from the Fed. As you know, it was more into 2 rate cuts for the year for the market, and now the market is moving towards 3 rate cuts, so towards the more dovish member at the Fed. So that, I think, will be key. But also we have another payroll report before the September meeting. So obviously, if we see more deterioration in the labor market by then, maybe the risk is that the market actually prices the probability of 50 basis point rate cut in September. So that's really the key things to watch.
The bond market's beginning to smell something, a slowdown. The bond market's beginning to think about the fact that things are changing now. The equity market isn't. The equity market is at all-time highs. You've got this divide now increasingly between the bond market and the equity market. You come from a fixed income background. I'm assuming you think the bond market is right. Is that the right way of looking at this?
But I would say there are two narratives. One, on the equity market, especially if you look at the S&P 500. So earnings were good for banks. Obviously, they lack the fact that you have a bit steeper yield curve for the last few months. The second is obviously linked to AI and all these tech giants, and that's not really the real US economy. So the bond market is more focusing on the economy, on the consumer, and we saw that from the companies that cover consumer, they were not having that strong surprise in terms of earnings. So you see that maybe the consumer is feeling the pain, and as such, the real economy will be more impacted than maybe the tech giants or the banks, at least at the beginning.
Laureline, talk to us a little bit about how you price in this market that is perhaps still navigating the differences in terms of who's actually going to cover Adriana Kugler's chair when it comes to her term in January. You know, Stephen Moran is going to temporarily, at least pending Senate approval, take that spot. What does the implication for the markets actually look like?
Yes. I would say the key thing really to watch is obviously who is up for the chairmanship. And what we got in terms of news last week, which was a bit of a surprise to us, is that apparently Chris Waller is quite up in the agenda of the Trump administration. And that would be taken as a very positive because, as you know, he's already at the Fed. Obviously, he has been calling for some more rate cuts than his colleagues. He has dissented last meeting. But still, he's someone that is not seen as unorthodox in terms of monetary policy. So I think that would reassure the market. And I think it's interesting to also look at the term premium. So what we have seen in spring is really the increase in the term premium on the long end of the US yield curve because of worries around the fiscal deficit and issuance. And that has been really well assuaged first by the tariff revenues, but also because the Treasury has really reiterated their focus on issuing much more T-bills than long-dated bonds in this current market environment. So that's one thing that is settled, and the term premium has come down quite significantly. But if we have a chairman at the Fed that is really seen as unorthodox and ready to cut rate aggressively in a context of higher inflation, you could actually see long-term inflation expectation move up sharply, and that would push up the long-term bond yields in the US.
You mentioned that kind of potential current flattening of the curve that could change. But Laureline, you mentioned issuance specifically, and I'm curious more, given these proposals of moving the issuance to the front end of the curve, what the digestibility of that looks like. Just a few months ago, we were talking about foreign investors not wanting to touch U.S. debt in any way. If we do see that increased issuance, can the market digest it?
So that's what is interesting with the plan that the Treasury has now, is actually they say they are not going to increase the coupon auction sizes. That means that everything that is notes and bonds will not be increased. So mechanically, because they will have to issue more, they have to replenish the TGA account at the Fed, they are going to rely on T-bills. And so the share of T-bills relative to the rest is going to increase, and they're obviously, that's where most of the issuance will be focused. Now, in terms of the demand regarding these T-bills, as you know, they have just passed the Genius Act that makes stablecoins much more of an asset, I would say, for everyone to buy, and most of them will be capitalized by T-bills. So that's really a new demand, and they actually mentioned it, the Treasury Department, that they see stablecoins and a reliable demand for T-bills. So they have found the new demand, and they will supply a lot more of it for T-bills.
Laureline, I want to ask you, I know we were debating just a few moments ago around this desk about the trades around the possible catalyst, the other catalyst this week, which could be a breakthrough of the U.S.-Russia talks happening in Alaska on Friday. Is there a fixed income trade on that, on either an escalation of tensions or a de-escalation of tensions? What's your thinking?
I would say the key thing here to watch is obviously the oil price, because the risk if Trump is disappointed, he could put some secondary sanction, and we know he has been quite harsh on India because they are buying a lot of Russian oil. So if he does put some secondary sanction linked to oil purchase, for example, and that means that a lot of the countries that are currently purchasing this Russian oil cannot do it anymore, the risk is that actually the oil price does go up. So I would say everything related to inflation-linked bonds or inflation break-even is obviously where you will see the impact, I would say, on the market.
How does that play into European government bonds, who tend to, I guess, they're a bit more exposed to oil because Europe is a oil importer? Would you expect a bigger rally in European government bonds if we get something like that?
So I think what is very clear from the European Central Bank is that they're very focused on inflation. They don't have this labor market thing that they need to follow. So when we look at really the European Central Bank, what is key is inflation. And obviously, they are comfortable. Inflation is close to 2%, but they look at headline inflation. So obviously, if you have much weaker oil price in the next few months, inflation is going to undershoot 2%. And that will, again, call for them to cut below the 2% deposit rate where they are now, which is considered kind of the neutral rate. So that means that at this level, they're probably not stimulative. But then if inflation undershoots significantly this 2% target, they will have to cut rates just to stimulate the economy and push up inflation again, right? So that's, I was saying, is the key thing to watch.
Certainly something we are going to keep a close eye on. I believe we're at a close $65 a barrel at the moment. We'll talk about the ripple effect there. Laureline Renaud-Chatillon, Senior Fixed Income Strategist over at Pictet Wealth Management, joining the program this morning. Coming up, we're going to bring you the latest on Nvidia and AMD agreeing to pay the U.S. government 15% of revenue from Chinese chip sales. It's an unusual move. What's the motivation behind it? Don't get Guy and Val started. We're going to have that discussion next. This is Bloomberg. Thirty minutes from the start of the opening trade. When you look at the futures picture, you are seeing green on the screen, but again, marginal moves in either direction. It is a August Monday, I think is fair to say, but outperformance over on the continent. The CAC 40 futures higher by 0.2%. I feel like that's all you need to know this morning.
Let's check on the European bond open. We're seeing a slight rally when it comes to the fixed income. We have a German 10-year yields down 1 basis point. We just had a previous guest around the table talk about a possible U.S.-Russia breakthrough and the lowering of oil prices that could entail could actually prompt maybe the ECB to cut further if then they're worried about deflation. So we'll see if that trade holds true. If we do get that kind of breakthrough, if we do see a rally more in European bonds than we do in U.S. bonds. But when it comes to treasuries, we're seeing a similar move, yields rallying around 1 basis point in the 10-year sector.
Story I can't get my head around this morning is this export tax that effectively the Trump administration is putting on Nvidia and AMD. They've agreed to pay the US government 50% of their revenue from Chinese chip sales as part of a deal to secure export licenses. Let's bring in our China economy and government editor, Alan Wong, on this. Alan, how are the Chinese looking at this? Are these chips they want? Are these chips they don't want? Are they prepared potentially to countenance this kind of export tax coming out of the United States? What's the picture there?
Yeah, let's just say that this is a really unusual arrangement, and Beijing hasn't made any direct and formal response to that yet. But we're hearing from some state-affiliated media outlets that they're unhappy about it. We have this CCTV-affiliated outlet called Yuan Tantian saying that, once again, attacking the NVIDIA's H20 chips that were designed for the Chinese market and chips that were part of this deal with the Trump administration, had alleged security vulnerabilities. Once again, it was repeating an earlier official line that those chips may not be as good as they touted to be, even though lots of Chinese companies would love to have them to help train and run their AI models. So does China want those chips or not? It's really hard to say, but it's worth going back in time just a little bit when after the most recent round of trade talks, China came out to say that the US side proactively offered those chips and that they didn't ask for them. So you could read it as China trying to negotiate, because we do know that Chinese companies would want those chips to train their models. But at the same time, China is also pushing back at the idea that China is desperate for those chips. But the bottom line is that with all this unusual arrangement with Nvidia and AMD with the Trump administration, I think it will give China all the more reason to speed up the development of domestic alternatives to those chips.
Alan, so that's the picture maybe from the China side. I think there's a lot of questions on just why on the U.S. side. Was this a move by Trump to appease the China hawks? Does he want to raise revenue from this kind of thing? And it also goes against this idea that these tariffs are being used to defend U.S. national security. What's the take?
Exactly. The original idea for curbing those chips export to China was that they were too powerful and it would aid a geopolitical rival like China, not just because it helps them develop an AI industry to compete with the American one, but also because they could be used for military purposes. So that was the original intention when the Trump administration banned those chips export in April and contrasted that move with the Biden administration, which allowed those less advanced chips to be exported to China. So by allowing their export once again, because now they have a revenue sharing agreement with the company selling them, would be seen as undermining the argument that those chips are a matter of national security.
Well, Alan, that's on the chip side. There are a lot of American companies that operate in China that get a good chunk of their revenue from China. It's not just Nvidia, it's Microsoft, Starbucks, Nike. I could go on, McDonald's even. Talk us through this idea of what kind of precedent it sets, not just for American companies operating in China, but international companies operating in China.
Yeah, from the reciprocal tariffs to the latest move, this revenue sharing program, you could call it, I think Trump has made it very clear that he's all about making a deal and negotiating. And for companies operating anywhere in the world that has exposure to the US or Chinese market, I think the takeaway would be that there may not be a coherent policy framework guiding these decisions, and the Trump administration could use a lot of different levers to get what it wants. And sometimes the path may not be as obvious or as logical as it seems. But I think Trump will call this a move to advance American interests. But just how this will play out, we're actually still getting very few details about the plan. So we'll have to wait to see.
All right, Alan Wong joining us this morning to break down all those details. We thank you so much for your time. We're going to dive into this very topic with our next guest, who argues that lessons from the 1920s and 30s suggest that a sharp increase in tariffs can significantly harm corporate profits and stock markets. Ian Harnett, Chief Investment Strategist over at Absolute Strategy Research, joins us around the table this morning. Ian, pleasure to have you, as always. Thank you for joining us on this Monday morning. Let me put that question to you that I just put to Alan. So many of the heavyweights in the S&P 500, and I would argue in the Stock 600 as well, have that revenue exposure to China. What kind of precedent does this morning's news set when it comes to pricing that into the markets?
Well, I think that people need to recognise that the weaponisation of trade is leading to the weaponisation of capital. And we're seeing this in a variety of forms, whether it's this kind of tax deal today or the demands that people invest in the US as an offset to a reduction in their tariffs. We're seeing the administration use multiple methods to try and make sure that their revenue generation is high and that the capital allocation to the United States remains high, despite the risk of retaliation. That's what they're trying to push back against. But as ever, it's a deal. It's the art of the deal. It's about, a two-way operation. You want to have our chips? Well, you want to sell your chips to China, there's a cost to be paid to that, and it's paid directly to us. Thank you.
So a couple months ago, we were really worried. This is pre-Liberation Day. The fear was all about the deficit and whether or not the U.S. budget would basically balance at the end of the day. We're hitting an X day in a couple of weeks/months, TBD on what that looks like. Does the math add up? Does all this revenue sharing, the tariffs, the DOGE cuts, does it add up to perhaps alleviating some of that pressure?
It alleviates some of the pressure. But remember that Economics 101 means that, to get the deficit coming down, you have to either see the current account improve modestly, and historically that very rarely occurs outside recessions, or you have to actually see the private sector surpluses come down. That means consumers have to spend more and companies need to invest more. And that's really what why DOGE was always doomed to fail, but actually the reason why the economy has to be run hot in the United States. And that's really going to be the story of the second half of the year. So, tariffs, trade, these are key issues. But actually, we're going to, for Scott Bessent to achieve his objectives, he needs the economy to run hot. And I know something that's dear to Guy's heart, that means that oil prices have to stay low unless they're going to have a big inflation problem.
OK.
Sorry, Guy.
Let's talk about the 1920s, because I think this is ultimately where this is going. You think that we're in the 1920s?
That's too far.
There are parallels to draw from the 1920s, when tariffs started at the beginning of the 1920s. But we're still in the 1920s. There were flappers, Babe Ruth, there was cars, there was radios, there was all kinds of things going on. But the story of the 20s was the roaring 20s and the roaring stock market that we had. Yeah. Why were tariffs so bad if they resulted in a stock market that boomed?
So I think you had a situation where, remember that we were coming off the back of the First World War. Yep. You had, the overproduction that started to come through, and the response to that. All the points that we were making in the article that we published in the Financial Times was, that you've only had 3 occasions where profits have really come down very aggressively. Over the last 100 years, the GFC and these 2 periods, the start of the early 1920s and the start of the early 1930s. Now, if you come from a situation, as we did in the GFC, from an absolutely atrocious profit write-down, of course you're going to get a big bounce back. You get some other policy response that comes to that. What triggers that is a moment of absolute horror in terms of corporate outcomes. And at the moment, the coincidences around those big profit drawdowns and the fact that you had some of profit tariffs at a similar kind of levels, 38%, on the average in the early 1920s, and more importantly, the biggest rise that you've seen in tariffs, sustained for a reasonable amount of time. These are the kind of things that I think create that uncertainty. And what concerns us at the moment is that the uncertainty that's there is not being reflected in market prices. At the moment, we are still positive because we don't see that being changed. Liquidity is plentiful, and we haven't yet seen those profits starting to come down. But we're just warning people, the precedents are out there.
How big does that hit need to be? This feels like a very robust stock market at the moment, and you have this AI trade. And that I'm wondering whether it's big enough to overcome the tariff hit.
Well, remember, that was also called the Gilded Age, and this is really the second Gilded Age with the introduction of this new general-purpose technology. I think the thing to recognise is that most people agree that when you get tariffs, it reduces growth and increases inflation. That historically has been bad for multiples, PE multiples. They always come down if you get that combination. So
I think would be a reasonable multiple on the back of that.
So I think that you would have to probably see multiples come back down towards more of the average type of level that you've seen over the last 5 years, 10 years. So not a disastrous type number, but that means that it becomes all about the profits.
You say it's not about disaster. You put the S&P on 18 times with the 245 trailing EPS. That puts you at about 4,300. That's a pretty big hit.
Companies can still trade at crazy multiples.
So this is where your profits growth becomes the critical factor. And whether those the tech companies, the Mag 7, can continue that in an environment where global trade comes down, because one of the strongest relationships you've seen over the last 50 years is it's almost a one-for-one relationship: global trade and nominal earnings growth. And so, that'll be the challenge for markets out there.
Ian, I have more of maybe a blue sky thinking kind of question.
Love it.
I guess if we take the known that there is a massive trade deficit in the U.S., which in some way does need to be corrected, or at least course corrected in some manner, do you think history will write down that actually taxing capital inflows, so correcting the current account surplus, would have been a better way to balance the trade deficit in the end, or to make the trade deficit less wide?
As I say, remember that the trade deficit is just the counterpart of other parts of the economy. You have to get the rest of the economy, saving less, and that's really at the heart of this. This problem. The current account deficit really is still relatively small. It's manageable. The trade, the budget deficit is the bigger issue here, rather than the current account.
Okay, so stop the government spending, stop everyone borrowing, and you eventually maybe balance the trade deficit.
It's more about actually trying to get the economy growing again, producing the goods that people want.
I did like your point there that, at least for the U.S. economy, they have to run it hot. You need nominal GDP growth in order to outweigh this growing debt burden. Do you see that specifically as a U.S. problem, or are you concerned that all Western economies under this debt pile are going to have to run it hot in the next decade?
I think that's one of the things that we see going forward, which is that you are likely to see higher nominal growth as the target here. Perhaps we'll dial back some of those inflation target ideas and move towards more of a nominal growth target. And that does mean a change in asset allocations. It means a shift away from having bonds as the counterpart and the inflation hedge in your portfolio, and having a broader range of assets. Not necessarily just crypto for you, but still a lot of equities, but also you're going to have a lot more commodities and commodity-related plays in your portfolios.
Great to see you. Thanks for stopping by to see us. Chief Investment Strategist at Absolute Strategy Research. Thank you very much indeed. Coming up, what have we got for you? We need to talk about some of the single stock stories that we're going to be watching this morning. Martin Sorrell's S4 Capital has received a merger approach. This, according to Sky News, shares are down nearly 60% since last year. That's one of the stocks we're going to be watching. Defence stocks, keep an eye on those names as well as we head towards the open this Monday morning. Plenty still coming up. This is Bloomberg. 12 minutes to the start of cash trading this Monday morning. European futures up a little bit. I love it when I read in the morning and there's lots of kind of narratives being tied to a 0.2 move. We're higher because of this, and the market's up 0.2. Doesn't feel like the market's going anywhere in a hurry this morning. We'll see what the catalyst looks like. There's going to be some single stocks that we're going to be watching out for. It's a big week coming up. There's an awful lot going on. You're watching crypto.
I know, it's a little out of character. I was just thinking, what is catching my eye? What's the story that no one's talking about right now? And I think everyone's talking about Bitcoin, but I think what people maybe haven't necessarily thought about enough is this idea of just kind of whether you should actually expose yourself in terms of your 401ks. Now, something, it's an executive order that Donald Trump signed on Thursday. It's something that I think, have talked about, we've known about for quite some time. But it's not just crypto, it's private assets as well. So I think if we're searching for a bear case, for the stock market, which again is a hat I don't often put on, it's crucial to be thinking about the fact of how much allocation you can actually put in private markets or in crypto. 70% of the U.S. stock market is owned by domestic players. A good chunk of that is coming from endowments, pensions, et cetera. If suddenly you reallocate to private markets, these private funds, to crypto, how much momentum does that take out of the stock market? I'm throwing that question out into the ether.
Or how many more fees do these private investment funds make off the back of that? But no, it's a very good point, Kriti, that diversification of 401ks into non-traditional assets could in some way dent the rally into those traditional assets. But this is happening at the same time we have Bitcoin at record highs. But are you going to put Bitcoin into your 401k after this? Are people really going to take this seriously and jump on it, Guy? I know you don't have a 401k because you're not American, but no. Is that something you would seriously do?
I don't know, but some people will. And it's really interesting that, are we getting to an inflection point in the cycle? It's interesting. So there's a piece in the FT today, Manny Roman, boss of PIMCO, talking about the fact that you haven't seen private markets being tested yet.
Yes.
And you haven't seen the crypto market being tested yet. It's had its ups and downs, but you kind of feel that it's more mainstream now, and there's a test coming, pass or fail. And I don't know, and it's...
But maybe this would make those private assets a bit more robust, because who sells their 401k during a drawdown? Normally people don't. This is a very long-term kind of investment, and it could make the asset better.
It could. That's the positive view. Or you could end up with this kind of shakeout of speculative assets.
Yeah.
Which is going to be really interesting to watch. And what do people sell first when they start to see the situation being tested? They tend to sell the easier things to get out of, but things can move very, very quickly at that point. I don't know is the honest answer. My real question is there a test coming at some point? It's interesting that Roman's talking about the fact that the private markets haven't been tested yet, and they're going in as well. I think the crypto play is small fry compared with putting private assets into 401ks.
Well, that's the argument, though, of putting it against it, right? It's that it's this juicy asset. It's long-term. It's kind of like a 30-year treasury, for example. Yeah. But it's also sort of a little bit of like a hand grenade as well in the fact that you're sticking in your portfolio. And if it explodes, the whole thing explodes. But then the bull case of that is because it's a private market, there's no contagion of it. There's no ripple effect. Could you make the same argument?
That was the story going
Bitcoin
into GFC, that everything was dissipated, that everything was managed, that everything would be understandable and quantifiable.
Until it got big enough to have a ripple effect. This is going to be an ongoing narrative as well, as we monitor kind of how this development actually takes place and what the adoption in the States looks like, not to mention in Europe and other parts of the world. In the meantime, we are 9 minutes away from the European Open. Let's get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's start with UK recruiters this morning. So we've got a survey by KPMG that shows that the UK labour market is weakening quite a bit on the back of the tax increases that came in a few months ago. So we should keep an eye out on companies like Page Group, Hayes, Robert Walters. All of those have had quite a tough year already. Robert Walters down 57%. And as KPMG said, this uncertainty will probably last until we get that budget in the autumn, when there'll be a bit more clarity. Moving on and staying in the UK, let's talk a bit more about S4 Capital. So S4 Capital confirmed this morning that it was in very preliminary talks with MSQ Partners about a potential merger, potential tie-up. The shares have been taking quite a dive over the last year. We're down almost 60%. So we'll see how much that changes. S4 is dealing with a bit of a slowdown in the advertising market. And then finally, Maersk, we've got a new price rating from JP Morgan for Maersk on the back of the earnings and the guidance last week. It's been outperforming its closest European peer, Hapag-Lloyd, so we'll see how much that picture changes there.
All right, Chloe Melly, our equities reporter, walking us through some of those stocks to watch. We thank you so much. One of the key conversations that we're continuing to have and monitor this week is going to be valuations. Guy loves a multiple talk. Let's talk about those defense stocks here, because there are a couple of catalysts that might be actually moving the sector. I'm curious how much of that gets priced in this morning. Val, you and I were here last week doing the heavy lifting. shaming you on
I'm allowed
public.
to take holidays every once in a while.
And one of the big conversations was this kind of unraveling of the defense trade. Now, we did have Rheinmetall come in short a little bit as well.
Yeah.
But how much does the narrative, the geopolitics, change this week?
Exactly. And the impetus to put this cash to work, these defense funds that they've raised, the infrastructure spending, will that kind of impetus to invest that money quickly kind of fall off the way lines? Because European stocks are very much pricing in these investment funds being deployed as soon as possible.
I think they probably do get deployed. And I think the long-term picture is that Europe will spend more on its defence. But is that now out of kilter slightly with the valuations that have been applied to some of these defence stocks? Or are these defence stocks just going to continue to run? There was, again, I read a piece over the last few days while I was on holiday, talking about the idea that basically private equity, this is anything associated with defence companies, anything associated with defence tech is the hot space in Europe right now. The pendulum always swings too far. Has it swung too far on defence? Is there a more gradual story here? And it's a fairly fast-paced gradual story, but nevertheless, is it something that works out over years rather than months and weeks and days?
Yeah.
Which is kind of what it's felt like over the last period.
Well, this is the rotation, right? I think in the last 6 months, because remember when Novo Nordisk was all the rage and it was all these pharmaceutical stocks, and Novartis was trading on Novo Nordisk kind of multiples despite not having the same exposure. It's gone from healthcare to defense. I think oil was in there briefly when we were talking about the geopolitics in Ukraine, but also in Iran and Israel, not to mention the Red Sea attacks as well. I'm curious what that next kind of sector is.
If you get a pace deal, what does reconstruction look like?
Well, and to Kriti's point, I mean, is the oil price more of a determinant in how European equities perform? We know that Europe is a oil importer, and if the cost of energy goes down, that helps many companies.
Helps Germany. Big time. Germany is the one that's really struggled with high energy costs over the last few years. Maybe that will be a big boost again. Triple boost, double boost. You think about all the kind of funding that's coming through in Germany. Anyway, we'll watch. We're going to see what happens with those defence names at the Open. Keep an eye on the oil trade as well. The Open is next, 5 minutes away. This is Bloomberg. Monday the 11th, good morning. Couple of minutes to go until the opening trade here in Europe. Let's talk about the legacy of Friday and what impact it could have this morning, because this actually could explain the slight bump maybe we're seeing in European futures this morning. You can pretty much ignore all the other kind of narrative pinning that's going on at the moment. This is where we went out in Europe. This is where we closed in the United States. There's a little gap there. Maybe that's what's being priced in this morning. I'm not sure there's a lot else that we can talk about. Everybody was talking about the fact that there were deals to be done and all kinds of things were happening, and that's why stocks were going to be higher. Val, I'm not entirely convinced. What are futures showing us this morning?
Guy, we're starting the week on a positive footing. Don't doubt it.
Point
we're
two.
in
It's
the
amazing.
green. Nearly 0.3 on the Euro Stoxx 50 futures to start this quiet week of August. We do have FTSE 100 futures also in the green. That's despite oil prices being lower on this optimism around the U.S.-Russia talks due to take place on Friday. DAX futures outperforming slightly. Maybe this is a hint that we are going to see some outperformance or maybe not so much underperformance in defense stocks this morning. Kriti, what do you think?
I mean, I don't have a hot take yet, although we are seeing some early pre-market kind of indications that maybe we might just actually see some weakness in that sector, and that's going to maybe flow up into that index story that you were talking about. There's a few others you want to keep an eye on this morning. Orsted coming out with their earnings story. It looks like their second quarter revenue is beating estimates, but look, this is a sector that's been very much under pressure when it comes to the unwind around some of the climate investments under the Biden administration. We know Orsted has quite a bit of exposure, especially when it comes to the New York area. So one stock we want to keep an eye on. S4 Capital is another. This is Martin Sorrell's advertising company in talks to combine with MSQ Partners. Likely to see a bid into those shares this morning, Guy.
Okay, here we go. Monday's trade. What are we going to see? Val was talking about 0.2, maybe 0.3. We'll wait and see exactly what the numbers deliver this morning. But there's actually some underlying narratives that are going to be really interesting. So let's take a look. What have we got at a headline level, at an index level? We've got a FTSE 100 that is staggering into the new week, up a massive 0.03 of a percentage point. Now goes negative, just right on cue. The IBEX is up a little bit more, up by 0.3%. What's going to happen with oil names this week? I think is going to be a really interesting build-up to what what we see in Alaska at the end of the week. What happens with CPI, I think, will also have a pretty big impact here as well. But the Stock 600 right on cue, 0.2 to the upside is what we are watching. But below the surface, there's defence names to watch out for. There's energy names. Keep an eye on Orsted. I think there's also a rights issue you maybe want to be looking at there. There's lots of kind of interesting little stories that are happening that maybe add up to something more significant. Kriti, Val, what's happening on the sector front? Break it down that way.
Well, on the sector front, we are looking very positive. There's only two sectors in the red so far in the first moments of trade. One of those being energy, not a surprise. We had a slide in WTI and Brent in the last few days. At the top of the basket, we do see healthcare, and we do have Novo Nordisk, one of the best performing stocks so far in this morning's trade, up some near 3%. We also have basic resources at the top, auto parts, and banks. But when it comes to those names on the downside, Kriti, a lot of those single names are defense that are catching my eye. We also have Vestas Wind Systems in the red. That might be following on from some other wind energy names that we did have reporting earlier. So I guess defense on a back foot and wind stocks as well.
Absolutely. Rheinmetall, BAE Systems, we'll throw Saab in there as well, just to name a few on the back foot as well. I think this does, however, feel a little bit of a rotation, though, because if you look at some of the bigger kind of outperformers, you mentioned Novo Nordisk, but I'm looking at AstraZeneca, for example, even Roche. These were the underperformers of last week, given some of the conversations around pharmaceutical tariffs, the 39% rate being imposed on Switzerland, even though carving out some of the healthcare space. But even some of the volatility around that has bled into that sector. So to me, this morning, it immediately looks like just a little bit of a reversal or continuation of the trade that we saw last week, Guy.
Yeah, so of the 600 stocks, we do have 440 in the red, only 440 in the green, should I say, and 111 in the red. So it does look like that this rally, even though it's small, is quite broad-based across the stocks, Guy.
Small but mighty.
Small, yeah, but the big names that have driven this market, banks have been the big outperformers so far this year, but kind of park the banks. Defence is down. So how much could it fall? Say you get to Friday, and there is a deal done on Ukraine. How much do these names fall? How much is already priced in? If you don't get a deal, how big a bounce are you going to be setting yourself up for? Is that the trade as well? Maybe you want to be long into. Do you want to be short into that meeting, or do you want to be long into that meeting, in terms of the narrative around the defense story?
Yeah, how to play this U.S.-Russia talks happening on Friday. Let's take that question to our guests here around the table. Joining us now is Laura Cooper, the Nuveen Global Investment Strategist and Head of Macro Credit. Always a pleasure to have you here. Thanks for joining us on this August Monday. What do you think is the trade for a possible detente of the Ukraine-Russia war? Is that something you're thinking about this week as a potential catalyst for your portfolio?
Well, it's one of the narratives that markets are focusing on, but I think it's important to look at the cyclical component versus the structural component. So on the cyclical side, we are clearly seeing that tactically kind of overbought in terms of the defense is a key theme that's emerging. So I think we're going to see a bit of a pullback if we were to see any type of peace deal. But if we think about the structural drivers of the defense sector in Europe, if we look at what is expected from defense spending as a share of GDP, the continent is expected to reach 3% by 2030. That is going to be a clear tailwind for earnings growth. We've already seen, 19% defense growth last year, estimated at 16% this year. Let's say about 8% annualized on the next kind of few years. That's a meaningful boost to defense stocks that we think is worth kind of still investing in. Just seeing any pullbacks is buy the dip opportunity.
Buy the dip in defense stocks. All right. Well, I guess you're buying today and all of last week. We saw defense take quite a hit. But for wider European equities, do you think that that's still going to be the tailwind to attract this foreign capital, this fact that we do have all this infrastructure spending to come? Or do you think any of that is going to be dented just because, is Germany really going to be deploying this capital quickly if there's not a reason to right on the table?
And that's the key catalyst that is the lack of a key catalyst that is keeping us still neutral overall on European equities, because we need to see more conviction that we are going to see some of this fiscal deployment come through more meaningfully. So in the near term, we've actually tilted back into that so-called U.S. exceptionalism trade, let's say, largely driven by what we're seeing come through in U.S. tech earnings have been exceptionally robust. If we look at what capital expenditure plans are for artificial intelligence, we think that's going to be a meaningful driver. And at the same time, when we are seeing this deterioration in the U.S. economic backdrop, those secular growers, the profitability metrics of these key tech companies, I think will come back into focus.
Do multiples matter when it comes to defense story? A quick search on the Bloomberg terminal. Nvidia is trading at a 41 PE multiple. Rheinmetall's at 53, almost 54. Do multiples matter in this environment?
I think valuations always matter, perhaps from more of a medium-term perspective. I think it's why we're seeing quite a dispersion across not just defense, but in European equities in general, that really does warrant a more active management approach rather than taking on some of those benchmark exposures. But in speaking with our European PMs, I mean, the way they're looking at it is we're going to see meaningful valuation shifts across the defense sector to capture in really this kind of game-changing fiscal stimulus that is really yet to be incorporated, I would say, at the micro level. In terms of corporate guidance, they're not incorporating meaningful defense spending, apart from a couple of the key names that you mentioned, but we'll see how that plays out.
Do I shift, though? Defense has had a great run.
Yes.
And as you say, we've kind of come an awfully long way. If there's a defense deal, do I want to be in the defense names? Sorry, there's a Ukraine deal. Do I want to be in the defense names? Or do I want to then think about reconstruction? I joked at the top of the show, this is about concrete now. Is there a big trade? Rebuilding Germany after the Second World War was a huge trade. It took an awful lot. Rebuilding Europe after the Second World War took a lot of resources, and a lot of money was being spent and deployed. We've had kind of phase one, which is the defence build. Is there a secondary trade to this that comes on the back of it in other areas of Europe? Is it steelmakers? Is it concrete? I'm joking, but there's an awful lot of stuff that needs rebuilding. I'm wondering where the money comes from, and I'm wondering who is ultimately going to benefit from that money being spent.
Well, I think when we look at it from a European equity lens, it's very much a regional story. I think Germany is going to be kind of the key catalyst behind a lot of that spending, whereas others like the periphery, are going to lag behind that. So you really kind of want to be more focused in something like the German DAX and taking less exposure in the peripheries, particularly when you look at how much financials have outperformed. Perhaps we're going to see less of that trade going forward. And then industrials. Industrials continue to be something that we do have strong long-term conviction in. But to your point, maybe European equities are tactically overbought, taking some chips off the table and looking for other opportunities outside of Europe.
Are you not worried about the concentration risk, again, is massive in US tech? Do you not feel that you and everybody else is buying US tech for exactly the reasons you've just laid out?
Well, and yes, and that's a key risk that certainly we're monitoring. I mean, valuations also come into play. When we look at the NASDAQ trading about 27 times PE. When it gets to 30 PE, that tends to be the cap, and we do see drawdowns on the back of that. But just look at the overall secular story playing out. I mean, capital expenditure on AI is expected to be about $200 billion annualized going forward. We look at some of the key components that are driving a lot of the digitization of the global economy. It's going to come from tech. Yes, we are going to see spillover effects in terms of European semiconductors is something where we see potential opportunities, but that's all being driven by these tech companies that have had that first mover advantage in the space. We are going to see that kind of second round, third round effects. But I think at this point, we're still taking that trade, at least on a tactical basis, from the 12 to 18 months.
Let's talk about something that might hinder that momentum you're seeing in the tech space. That, of course, is the relationship between the United States and China. This morning, what the news is Nvidia and AMD are likely giving 15% of their Chinese chip sales right back to the U.S. government. In the next 24 hours, the trade truce between the United States and China expires. What do we get out of that? These are the world's two largest economies. What does the price action look like going in and out of that expiry?
I think we're going to see more bouts of volatility because the recent news just captures that we are seeing these kind of piecemeal deals come through, but not kind of that holistic trade deal that really investors are looking for from trade clarity. Now, in terms of how we're positioning, we don't think that's going to be a structural dent on the medium term for U.S. tech. And then when it comes to China, we've actually downgraded China largely because of the growth backdrop. In part, that's because of what we are seeing in terms of the trade dynamics. But we're also not seeing the type of stimulus that is needed, in our view, to bolster the Chinese economy. We had the Politburo more recently who really signaled a wait-and-see approach. So it's one of the reasons why we're still quite cautious on China and seeing exposures elsewhere in EM. And again, just pivoting back into that U.S. story, despite some obviously risks still ahead.
Well, Laura, the big part of the U.S. story, I think, does remain to be seen on the tariff impact on inflation. We have CPI on Tuesday. What do you think we're going to get, and what is the market reaction off the back of it?
It is going to be a crucial print, just because it's one of the key kind of inputs into the Fed calculus. I think at this point we are going to see further gains in terms of the goods price inflation. We're already seeing that come through. We'll actually be watching for the super core gauge. That does tend to have a high correlation with nominal wages. It will signal whether we are seeing any broadening of price pressures beyond goods inflation. The Fed has clearly said they see this as a one-time shock, likely to be contained in goods. So tomorrow's print won't necessarily be a game changer. We think at this point, 25 basis points is cemented for September, but certainly a trend to watch for.
Are you focused on housing disinflation at all? A lot of people saying that the immigration story can lead to some decent disinflation in housing, and that could really dwarf core goods inflation.
And it's one of the reasons why we've seen overall headline inflation remain fairly contained, just looking at the overall downtrend that we have seen in services inflation. And the question is, if we don't start to see meaningful tariff inflation in goods pick up in the next couple of months, then perhaps the Fed is positioned to actually cut 50 basis points in September. I mean, that's not our base case, but I think it is going to be that key debate among market participants.
There's two people that have said
forward.
that this morning.
Yeah.
The bar is very high.
Unprompted. Okay, you mentioned September 50 basis
It's your vibes, kind of.
It's not priced in. I think it's good risk reward here, Guy, if you want to take a punt.
What is the risk of a high inflation print? If it does start to show up? Then what?
I think at this point, because we've seen such a significant repricing in the front end of the curve over the past week since payrolls, we are going to see a bit of a knee-jerk reaction on the back of that. But I think at this point, we still see inflation above 3% this year, which does suggest we are going to see upward inflation prints. But again, the Fed narrative has been they're going to see disinflation pressures next year. They're clearly focused back on the labor market, the deterioration there, the wages that are easing at the margin. So I don't think it's going to be
I didn't get that from Powell. Powell sounds he's concerned about inflation. He's still banging that drum. Why do we think the Fed, in its entirety, is more focused on the labour market? They got burnt once. They got burnt on inflation. Do you think they're going to make the same mistake again?
Well, and that's why they've been on pause for so long.
Sure.
I mean, and essentially, if you take a step back, looking at the recent jobs revisions, we've seen 3 consecutive months of fairly weak job prints now.
Sure.
That was kind of the threshold needed for them to cut 50 basis points last September. Again, it's not our view, but I think it just captures that this kind of divergence between the hard and soft data in the U.S., we're actually seeing more of that hard data capitulate by a greater degree than I think the Fed certainly had kind of been anticipating. So it does certainly warrant a 25 basis point cut, regardless of whether we see, 4/10 print tomorrow on core CPI.
Okay. Laura Cooper, Global Investment Strategist, Head of Macro Credits at Nuveen. Core 6 looks like this. Let's talk about what's going on. Defence stocks are under pressure this morning. Orsted's under pressure. You've got Schneider down a little bit, but everything else is ticking a little bit higher. Let's figure out what else we need to be watching. Chloe Melle's here with the details.
Good morning, Guy. Let's start with the defense sector this morning. So we see, as we can see, a little bit of weakness across that sector. Hensoldt, Rheinmetall, BAE Systems. We've also seen some downward moves in Leonardo, for example. That's on the back of the potential truce deal between the US and Russia over halting the war in Ukraine. Moving on to Orsted, the wind turbine space. It is down almost 24% this morning. So the revenue actually beat estimates. But what investors are focusing on is the rights issue that Orsted is planning, and that is sending the shares down by quite a lot this morning. Moving on to S4. S4 Capital is up 7% on the back of the potential merger with MSQ Partners, and that is providing a little bit of a boost for S4 after quite a tough year. And then finally, Novartis. Novartis said that its autoimmune drug that it is developing is succeeding in key trials. That's providing a bit of a lift in the shares as well, up 2.5% this morning for Novartis.
All right, Chloe Melle from our equities team walking us through some of those early movers. We thank you so much. Coming up on the program, we're going to do a little bit of a deeper dive into the shares of Orsted, falling sharply this morning after reporting a new rights issue plan, now officially below its 2016 IPO price. That conversation next. This is Bloomberg.
We're 17 minutes into the equity market session here in Europe, and this is the picture. at an index level, you're not seeing a great deal of activity, but below the surface, there's some interesting stories that are developing. Defense is down this morning. That is one area you want to watch out for. Orsted is taking a really big hit on the back of an announced rights issue this morning. We'll come back to that story in just a moment. But broadly, these are markets that are waiting for the next big catalyst, and there are big catalysts that could potentially come this week. One in the form of CPI, the other one in the form of this Alaska meeting. But you've also got there's other stories that are bubbling up. This lithium story out of China, I think, is really interesting.
The fact that China has kind of, at least from a news flow perspective, fallen on the back foot, I think is crucial here from a narrative point of view. But of course, as this lithium story takes foot, we're trying to connect the dots here in terms of what it means for the European markets. Chinese battery giant CATL has suspended activity at a major lithium mine in China. Now, we understand that the closure could last at least 3 months. When you talk about the European read-through into that, this is where we struggle a little bit because this is part of the supply chain for a lot of the EV space, but it doesn't have a direct impact when it comes to Europe. For more on that, we're joined by Bloomberg's Global Autos editor, Craig Trudell, on this story. Craig, just connect the dots for us.
Yeah, I mean, this is, in short, a case of China and CATL specifically having so dominated the sector, and the criticism for some years now has been they've done so by sort of deliberately, putting themselves in this position of overcapacity to where they could drive their costs and prices down so much that they could build this massive domestic industry that then could turn into a significant export base. That has absolutely come to pass. And yet there's been a lot of criticisms externally about, this can't last, that this can't keep up. And you hear this even from CEOs in the U.S., Mary Barra or Jim Farley at GM and Ford. This is a case of sort of, something coming home to roost that everyone has been predicting for some time, that surely you can't, sort of keep overproducing and driving prices down to such a tremendous degree forever. At some point, something's got to give.
Lithium prices have come down really sharply.
Yeah.
I'm just looking at the chart now. 2022, we're in the 80s. We're now in the 8s. Right. 7s. We're kind of at 8. So a huge drop in the price of lithium. If I was to take an average EV, how much of the cost of an average EV is lithium? I'm sure you don't have the exact number, but is it significant?
Yeah.
Are we going to see, if prices rise of lithium, are we going to see rises in EV prices? Because lithium prices have come down. I haven't seen EV prices coming down very sharply.
Well, and I think that's the real question here, right? Where because we have seen prices come down for batteries and for EVs in China, and it is in no small part because of the fact that we've had so much production of these raw materials. Absolutely. Okay. And so, and our colleagues at Bloomberg New Energy Finance at BNEF track battery prices on a yearly basis, and you have seen these dramatic reductions and differences.
Because of raw materials.
And because of raw materials being a big component of that. And we've seen those prices, though, we've seen dramatic come downs for China, but in terms of that filtering through the rest of the world, because of the fact that the rest of the world, has so struggled to compete with China to build their own domestic, say lithium or other raw material industries, we've not had a sort of opening for other suppliers to be able to compete because prices have been driven down so dramatically.
Craig, why did China choose now to act? Are there broader implications of this? We know that the U.S.-China trade deadline is Tuesday. Does it have anything to do with one another?
I don't think so. I think this was a sort of specific instance of a license for this mine sort of coming due. And so it is definitely interesting that aligns with these trade talks, because it is obviously, sort of, makes one question.
Timing.
Yeah, it makes one question whether the two are aligned, and I think it's a completely legitimate question. But I think this sort of opportunity was brought about by the fact that this had an end date, and we've reached that point. There's been some speculation, just given the dynamics in this market, the dramatic come down in price, that something was potentially going to give here. We had reports coming into this weekend of people flying drones over this mine. There was a lot of speculation that this mine was potentially going to be headed for this destination of a shutdown.
Craig, a final question to you, kind of on the same theme that Valerie was hitting. We are less than 24 hours away from some sort of development on the U.S.-China trade front, whether that's another extension, whether that's a breakthrough. Tesla has been kind of nestled between these two superpowers. Walk us through what the impact might be. Where are they most vulnerable? Where are they perhaps not?
Well, when you talk about a China trade perspective for them, what they point to immediately is the energy business. And, the car business, of course, is the predominant, portion of their revenue, of their profits as well. But, in terms of what they're reliant on China for in the rest of the world, it's LFP batteries for energy storage systems. And as we've seen this real slowdown with their EV sales, we've actually seen the energy side being a source of growth. That suddenly has come to a halt because of these tariffs taking a real serious hit to that business. And so, you've not only had this slowdown of EV sales that everybody's paid a lot of attention to, but also that EV storage, industry. If they continue to have this significant, challenge of higher tariffs on those batteries, that is a business that is in real trouble.
Nice to see you. Let's stop by to kind of explain it all, trying to figure out timing, what impact it's going to have. Kriti Gupta, thank you very much. Let's talk about how some of these electrons are generated that go into some of the cars that we've just been talking about with Craig. Some of them come from wind farms, and that is my segue into talking a little bit about Orsted, which is certainly not feeling the power this morning, and the stock is down, as you can see, quite sharply. The analyst take that I'm reading at the moment is that the rights issue that's being announced this morning is basically short-term pain, long-term gain. This is a company that needs to stabilise its balance sheet, and as a result of which it's going to issue equity to do that. But you can see the short-term pain in terms of the stock this morning. It is down by nearly a quarter, 24.4%. Let's find out why. Christian Weinberg, who covers Orsted out of Copenhagen for us here at Bloomberg, joins us now. Christian, just explain why this is necessary, why so much short-term pain is required by Orsted to stabilise things maybe over the medium term.
Yeah, well, it is a surprise that they're doing it. As you say, it's definitely short-term pain. Orsted has had a lot of issues facing higher costs for their wind turbine parks, and especially in the US and also in the UK, they have cancelled or delayed projects. So the company has faced these issues which have weighed on the balance sheet. It's a bit of a surprise that they do it now, because the new CEO who came in at the beginning of this year said that he was able to turn things around with his cost cut and his investment reduction plans. But perhaps he has looked at the balance sheet and said, well, maybe it's time to do it now anyway, despite the measures that he has set into space.
Christian, we'll leave it there. Thanks very much indeed for the updates. Christian Weinberg covering us on Orsted, talking about what is happening. This is a Trump effect.
Yeah.
Like this is what happened off New Jersey. This is Trump not liking wind farms, particularly at the end of the 18th, but generally not liking wind farms. The UK, though, has gone down this road very, very heavily. Yeah. It is rippling through. It's going to be interesting to see what Vestas has to say about all of this, what the effect of all of this is going to be. But this is a sector that for a while looked like it was going to literally take off. But now the Trump administration has put that very much in the rearview mirror.
Yeah, and you wonder, just will this deregulation when it comes to the EPA, having a mandate about carbon emissions, is this just the beginning of this deregulation in the energy industry? I think that's what it makes me ponder, at least.
Imagine losing almost a quarter of your stock value without even issuing some sort of stock split or at all. I mean, that's the pain that we're kind of seeing in Orsted this morning. I'm curious if it recovers.
More shares. Dilution,
no, sure.
That's what happens. The arithmetic is fairly straightforward.
Well, the energy industry in turmoil, that's for sure. Well, coming up, EU nations are seeking talks with President Trump before his meeting on Friday with Vladimir Putin. We'll have the latest on that next. This is Bloomberg.
Minutes into today's session, and it's starting to feel like the flowers may be coming off of the bloom, at least when you look at the DAX. I think this is really indicative of what we're seeing underneath that hood. That unwind we saw in the defense story last week really kind of flowing into this week as well. And that's why the DAX is the underperformer. But again, not by much. These are some sleepy markets because on the index level, if your outperformer is the stock 600, higher by 0.2%, or I should say the FTSE 100 actually, only moved by 0.3%. I think that tells you everything you need to know about this August Monday, Guy.
Okay, let's talk about the internals. What is happening in this market? You got a lot higher than lower at the moment. You would have thought, therefore, this would be a market marching on the front foot, but it's not. Volume is super light. It's August. Of course, it's going to be super light. But let's talk about some of the 52-week highs and lows. Let's whip through these and just show you some names and numbers to give you an idea. Raiffeisen, British American Tobacco, Holcim. Look at that, Holcim, 52-week high on Holcim this morning. The concrete trade, we were talking about that. Is the reconstruction trade going to be the next defense trade, or is the defense trade going to morph into a reconstruction trade? That's the potential Ukraine narrative. Let's look at some lows, though, because that's where we're also seeing some pretty interesting trades as well. Let's just whip through some of these names, and there's a few that you really want to stand out and look at. Orsted is obviously the name that is really in focus this morning. The stock down by 26, nearly 27% this morning. 52-week low, definitely. That's on the back of the rights issue. Short-term pain, maybe some long-term gain here, Val. We'll wait and see. This is the Trump trade as well, in action here in Europe.
Well, here's what else you need to know this morning. U.S. President Donald Trump says he hopes China massively steps up its purchases of American soybeans. The comments come just one day before the trade truce between the two countries expires. And Bitcoin has risen within striking distance of an all-time high as demand from institutional investors and corporate treasury buyers lifts the wider market for digital assets. And Bloomberg has learned that European leaders are aiming to talk to Donald Trump ahead of his meeting with Russian leader Vladimir Putin on Friday. Putin is demanding that Ukraine cede territory as a condition to unlock a ceasefire. Zelenskiy said over the weekend that Kyiv won't and constitutionally can't cede any territory. Kriti?
Yeah, it's a fascinating one here in terms of what the ripple effects actually are when it comes to this Ukrainian-Russian American, if we can throw it in there, truce deal, because there's so many different outcomes here, Guy. The idea that we have the same outcome as last time around, where it kind of feels like we're heading to this idea that Vladimir Zelenskiy is saying no territory is ceded, where European leaders saying no way. I think the game changer is that the NATO Secretary General, Mark Rutte, actually saying, this might necessarily have to be on the table.
It might be on the table. Whether or not it stays on the table remains to be seen. It'll be interesting to see how the Europeans influence the narrative this week. It's interesting to listen to the Vice President, J.D. Vance, saying basically, if you're so wedded to this idea that we don't see territorial shifts, then you need to stump up the cash to keep this conflict going. And I think that's going to be something that the Europeans are going to have to think about as well. But that feeds us back into the defence stock story. There is an odd outcome here that if you don't get a deal done, Europe may need to spend even more on defence. So actually, it'd be interesting to see how this trade works by the end of the week.
Is it a relief factor in the European markets or a massive negative and a continuation of the unwind we're seeing at least today and for most of last week? Let's dive into the details, though. For more on this, we're joined by Greg Sullivan, Bloomberg's Russia economy and government editor. Greg, just give us some of the nitty-gritty here. How likely is it that Ukrainian President Vladimir Zelenskiy will be presented with a deal that forces him to hand over some of that territory to Russia? Is this a repeat of what we saw a few months ago?
Well, that is the biggest worry among European capitals and in Kyiv itself. They do worry that there is a deal that's going to be done without them at the table that does call for land to be ceded. That, of course, is something that Kyiv has ruled out as constitutionally that they just can't do under the Constitution. They can't cede their sovereignty. So this is not something they want to see. Europe views it as huge concessions to the aggressor in this war, Russian President Vladimir Putin. So they don't want to see this. Another big issue is that there hasn't been much talk of security guarantees for Kyiv. If there is such a deal, and clearly land has come up a lot in this, but not the security guarantees that Kyiv has sought. If the conflict is going to stop, what is going to prevent it from restarting again? So that hasn't come up. Now, of course, Europe has sought to try to influence the Trump administration to make sure that their concerns over land, over security are taken into account, but yet they don't really have as many levers to influence Trump. And clearly, they're not at the table at the moment. They're not at the table in Friday's meeting, and at the way it looks right now, it's unclear whether even Zelensky will be at the table. It doesn't look like he will on Friday. So those are real fears among them.
All right, so Greg, you mentioned Zelensky might not be at the table at these discussions on Friday, but is it likely that Trump is going to put to Zelensky in a kind of deal or no deal scenario? And in the, outcome that Zelensky chooses no deal, could Europe make up for the lost U.S. support in that scenario?
Well, that is a great question. Europe, their industrial military production hasn't been going quite fast enough to potentially close that gap. Right now, Ukraine has up until now really relied upon U.S. support, both in intelligence and military armaments. Europe just doesn't always have the same weapons that are needed, or if they do have them, they're not always in the same quantities. So it's unclear how much they can actually provide to Ukraine. Certainly not as much as the U.S. with the U.S. pulling back. Now, of course, there was that the U.S. did say that they are willing to sell Europe the weapons to provide to Ukraine. J.D. Vance, in his comments in Europe, seemed to underscore that that would be the arrangement going forward, that the U.S. doesn't want to financially fund Ukraine. But right now, the way it looks, Europe just can't make up that gap. So they can be vocal in their support, but when it comes to actually providing physical armaments, it doesn't look like they can actually close the gap for Ukraine.
In terms of what could ultimately come out of this, is the next play, if we do get a deal over the weekend, so say something is put together, the details sort of come out on Friday, and we start to work our way through the weekend, and we start thinking about what could come next. Is there any idea what could come next? What would Ukraine look like at the end of this conflict? If that conflict came to an end quickly, what would happen? How could the Europeans pivot on that? I'm just wondering what the next phase of this looks like. We're so focused on kind of how we end it, but we need to think about what comes after that.
Of course, and there's a number of scenarios that could play out here. One, if what comes out on Friday is a deal that Ukraine just can't accept, then it's hard to see the fighting stopping. If Ukraine can't accept the ceasefire because of a land swap, that puts them in a very tough position because they will essentially have to keep the fight. So not much progress would be made in that scenario. If there is a deal that is somehow tenable to Ukraine, even for a temporary ceasefire, then of course negotiations will have to continue to try and get to a permanent ceasefire, to a permanent resolution of the conflict, with the possibility that fighting could continue or flare up again. Remember, in 2014, Russia annexed Crimea, and there was still some simmering tensions and fighting. And again, it flared up in 2022 with the invasion of Ukraine. So there's always the possibility of fighting again in the future, something that Ukraine has made very clear that they're concerned about, which is why they have striven for security guarantees, something to prevent the conflict from restarting or from Russia from saying down the line that they want more territory.
Yeah, and the concern here is that Russia is given breathing room to add to its military might and therefore proceeds with another conflict further down the road. Greg, great stuff. Thank you very much indeed for updating us. It's going to be a busy week. We've got a lot to debate as we work our way through the week towards the meeting in Alaska Friday. Joining us now, Jane Kinnemont, CEO of the United Nations Association UK. Thank you very much indeed for joining us. Good morning.
Good morning.
What do you expect on Friday?
At best, I think there will be something called a framework agreement that is proposed by Trump and marketed to both Russia and Ukraine. Yeah. The idea of that, which is being written about by some well-connected think tanks in Washington and elsewhere, is that you would set some kind of parameters for what peace talks would lead to. At the end of the day, this conflict has been going on at high intensity since 2022, but from the point of view of many, including Ukraine, it's been going on since 2014. You're not going to end a conflict like this quickly, but you could start a process with a sense of there being shared end goals. It would take many months.
What do you think those end goals could be? Is it land swaps? Is it security guarantees? What does an end deal look like?
There will be some focus on security guarantees, which may well be instead of NATO membership, something that would represent a compromise for Ukraine.
And Putin would be okay with that?
There's a lot of devil in the details here, but I think there would be something for each side to market to their home constituencies as some kind of victory. Potentially, Putin could say, I kept Ukraine out of NATO. But security guarantees are very tricky. We know that European countries, including the UK and France, have security agreements with Ukraine. They want to provide those guarantees. But they will, at the end of the day, be nervous about putting troops on the ground unless they feel the US would back them up, including in dire scenarios such as Russia threatening to use a tactical nuclear weapon, which we cannot rule out. So the US would need to be willing to provide some kind of guarantee. Of course, that's an area of great uncertainty.
Well, speaking of those tactical nuclear weapons, Jane, in the last 7 days, we've heard that Russia, unsurprisingly, is pulling out and has called the treaty of the INF Treaty of 1987 kind of dead in the cold water. For international audience, that's basically the intermediate nuclear missiles that have been agreed to be taken off the table, basically putting back on. Plus, there was that social media exchange between Donald Trump and Dmitry Medvedev as well. Why did Putin say yes to this, despite the fact that we are now talking about Donald Trump very publicly saying there are nuclear submarines in the water, that there is this kind of frigidity between some of the folks representing Putin as well? Why did Putin say yes to this?
Well, in many ways, when the talks focus on nuclear, that's an area where Russia is quite comfortable. If you look at the history of summits between US and Russian leaders, really they became very, very important after the Cuban Missile Crisis, because the world could see whether or not these leaders agree with each other, they need to be able to talk at the end of the day on nuclear weapons, or the whole world can potentially suffer. Today, Russia isn't the global superpower that it was during the Cold War, but nuclear weapons are one of the ways that it gets to remain relevant. And it has hinted at those weapons coming into play in Ukraine some time ago. So I think this kind of heated nuclear rhetoric that you've seen is part of the preparation for the summit in a way. But I wouldn't be too relaxed about this, of course, because all of these agreements really are falling apart. There's one remaining arms control agreement governing nuclear weapons, New START, between the US and Russia. That expires in February 2026. So one of the things Trump and Putin may also be talking about is what might come after that.
Wow, a little bit of, speaking of deja vu, which has been a theme of the show today, talking about a deja vu of the Cold War. Talk to us about the economic war machine behind it. In the last 7 days, again, we had 50% tariffs being put on India now as a punishment in terms of buying Russian oil as well. We know other pressure has been put on other Russian allies as well. How much more money does Putin have to continue this?
Well, the Russian economy has really defied predictions of buckling under sanctions, because at the end of the day, an authoritarian government doesn't necessarily make its judgments based on the overall health of the economy and the job prospects for its people, but rather on its own ability to sustain itself and the constituencies that are most important to it. So far, they have developed a war economy that has managed to keep going quite successfully. They have been able to get round quite a lot of the sanctions on oil as well. And although Russia is losing out in terms of its access to global technology, that is more affecting its medium to long-term growth prospects rather than putting pressure on Putin right now.
Jane, we've heard that the EU foreign ministers are holding an extraordinary meeting today, and that European leaders have been wanting to speak to Trump before he meets with Putin on Friday. Do you think Europe deserves a seat at these negotiations and at the table on Friday?
Europe will need to have a voice, because at the end of the day, if there is to be a ceasefire in Ukraine, it's very likely that Europe will be involved in monitoring that in some way, whether that's through the OSCE organization or some kind of bespoke monitoring mission. Europe may well end up being the primary financier of Ukraine, both in terms of the military effort but also the reconstruction, for a long time. So they can certainly say, we're going to be involved and we need to be acknowledged. But we know Trump strongly prefers bilateral to multilateral.
If European leaders do get on the phone with Trump before this meeting on Friday, what do you think they'll push for?
They will push for a US underwriting of European security guarantees. They will say, we are willing to put European potentially boots on the ground. We're willing to put Europe at the forefront of this. We've done what you asked in terms of upping the defence spending commitments and all of this. But we want to know that if Russia threatens nuclear weapons against us, the US will be there backing us up. That will be the kind of offer that they're asking for.
But what's the point of that, Jane? I mean, the US can see through that. Everyone can see through that. We know the US doesn't want to do that. They don't want to put boots on the ground. Why would they even indicate any sort of willingness to back up the Europeans? The idea that J.D. Vance has put forward famously in the Munich Security Conference was the Europeans are at this alone in every way except for when a conversation needs to be had with Putin.
I think Europeans accept there'll be no US forces on the ground, but they'll want to feel that there is a kind of backer of last resort, that if Putin was to hint about nuclear use, then he would get threats in return from the US, but probably very, very quietly. They will also want the US to give them access to intelligence and so forth, but they will appreciate that Trump would want all those things to be quite subtle, and that he would want to be able to show his constituents that he's succeeded in getting Europeans to step up. And I think all of these phone calls will involve quite a lot of flattery and telling him that he's been a roaring success.
What would reconstruction of Ukraine look like? What would be required to allow that to happen? How long would it take? What comes next? Say a deal is done, a security guarantee is achieved, that the fighting stops. What happens after that?
So businesses will be interested in going back into Ukraine, but these won't be businesses that have quite a high tolerance of risk already, because I think that there will be a lot of ongoing questions about what the security guarantees will look like. And it's an economy that's probably going to remain quite militarized for the foreseeable future. We will probably see a lot of interest in military and technologies associated with
those things. There's a lot of infrastructure, like roads, railways, hospitals, housing. So much needs to be rebuilt.
And there will be money coming in from Europeans and from international financial institutions that will help a lot of that. But ultimately, the amount of investment is going to depend heavily on whether there can be an underwriting of security to help make that happen.
Okay, nice to see you. We'll wait and watch.
Thank you.
Build up to Friday. Jane Kinwald, CEO of United Nations Association UK. Thank you very much indeed. Let's take a quick look at what is happening with one of the stocks that we're watching so carefully this morning. That is Orsted. The wind farm company is down by, as you can see, 26.2%. This not on the back of the numbers it's produced this morning, which actually exceeded expectations, but on the back of the rights issue it has announced to stabilise its balance sheet. We'll come back to that story. Down by 26% right now. This is Bloomberg.
Welcome back to the opening trade. We're 50 minutes into today's cash trade session in Europe, and the rally does seem to be petering out just slightly. Euro Stoxx 600 up 0.2%. We are seeing NASDAQ futures dip into the red for the first time this morning. S&P 500 futures also very close to entering the red. So maybe that kind of excitement from these U.S.-Russia trade talks wearing off as the cash equity trade goes on. But let's go to Switzerland, where the government has reached out to local drug makers Roche and Novartis to discuss the tariff situation. It comes after the country was hit with the highest U.S. levies in the developed world. Bloomberg's Paula Danecki is in Berlin and joins us now. Paula, so far, pharma firms have not been hit by tariffs, but that could all change. And what effect could it have?
Exactly. So President Trump said last week that in the next week or so, he might announce tariffs on pharmaceuticals as high as 250%. Now, that could play out very differently because it's quite a complex market. I mean, what happens first is that obviously that drugs, that drug makers like Roche or Novartis import into the US, they have to pay those tariffs, which means either they pass them on to patients, which is obviously difficult, as President Trump made very clear he expects those drug makers to decrease prices, or it will affect their margins quite badly. Now, what Trump wants is them setting up production facilities in the US, and in fact, they have pledged to do that, though it will take some time. It looks like the US administration has an understanding of that, and they said those tariffs would be phased in over some time. They would maybe be smaller at the beginning and then grow. So it's not unclear. It really depends on the timing and how the rules will be specifically.
Other sectors that are going to be affected, what else should we be watching out for?
Other industries that we should be really looking at is the Swiss watch industry, because they are so proud of their Made in Switzerland trademark. And obviously this is kind of what the Trump administration attacks, because this is what they have to pay the levies on. And it's not clear yet. We know Swatch told us that they have exported quite a bit of their watches into the US to make sure that there is enough product there for now, and everybody hopes, I guess, that those tariffs will come down at some point. But if that's not the case, and if they have to import their products to the US, they will be very expensive, and it will hit their margins and also profits.
Absolutely, something we're going to be keeping a close eye on. Bloomberg's Paula Dunica joining us out of Berlin. We thank you so much for walking us through some of that that we can expect this week. Let's talk about some of the other things we can expect this week as well. We've got a couple of earnings sprinkled throughout the week, but I think the data seems to be the hot button issue. UK labor market data due tomorrow. Of course, US CPI as well, plus the expiry of that trade truce extension between the United States and China. That's going to be a key story for tomorrow. And then going into the end of the week, we've got that PPI data and U.S. retail data. Inflation, consumer confidence out of the States, very much on the front foot. Val, what else is catching your attention?
Well, I was reading over Michelle Bowman's speech from Saturday. I was really surprised that this speech wasn't more juicy, Guy. I thought if someone was going to mention a 50 basis point cut in September, it was going to be this lady. She did not. She reiterated it in her view that the Fed should still cut at 3 times through the remainder of the year, so that is a cut at every meeting. She also harped on her view that she basically the reason why she dissented in that decision was because she sees greater risks to the labor market than inflation. For her, it's all about this move in core services and housing. That tick down in inflation is the reason why she thinks the Fed should keep cutting. If we flip on, I want to just show you what the picture looks like at the moment of U.S. inflation. We are seeing core goods tick up, and that is worrying some of the hawks out there at the FOMC. But the doves, you got Waller, you've got Bowman, are way more focused on core services, on the housing disinflation. If that stays on track, the Fed should be cutting.
Last time I heard from Powell, he pretty much ignored these people, and I thought that was really interesting as well. I don't know. Would 50 basis points be an emergency cut? How would the market react to that? I don't know.
But that's reacting. So I have all the sympathy in the world for Jay Powell and the folks on the Fed at the moment, because if you lean into that, if you lean into this revisions data, if you say, okay, the labor market is cracking, this is the moment to act, we get it, we are hearing Donald Trump's message, and then the tariff numbers, the tariff read-through shows up in the fall into holidays, then suddenly you're like, wait a second, we were right all along and we've moved too fast. And I think that's the fear that seems to be I don't know, haunting Jerome Powell?
Exactly. Yeah. He's been bitten by the inflation story before. Does he want to get bitten again?
But the not acting is equally painful.
I agree, potentially. And the labour market can accelerate really quickly on the downside when it happens. Mm-hmm. But would 50 basis points be conceived as an emergency cut?
I don't think so. No, we've gotten clarity on inflation. We've gotten clarity on the labor market. And as you just said, when the labor market deteriorates, if we look at history, it deteriorates rapidly. So that is enough for them to bring those cuts forward. So is that good for risk or
is that bad for risk? So if the labor market is deteriorating rapidly, that implies that we are in a situation where actually the economy is slowing quite fast. Mm-hmm. Will the stock market see 50 basis points as a good thing, or actually look at the data and go, this is an economy that's slowing down? I know the answer to this question.
No, but we have to then separate out what you mean by the equity market. If you mean tech stocks, no, I don't think they're going to be worried about this. If you think about the rest of the stock, the Russell 2000s, the small caps, yes, those are going to get hurt. But I don't think the AI trade is going to get hurt, and it's hard to really be bearish on the S&P 500.
So the 50 basis points is neither here nor there for the S&P 500.
I think in some ways you can argue that, yeah.
Right.
That's a bit much. Come on, like it's such an if
lower front end rates do help economic growth in some way, right?
No, absolutely, absolutely. But it would also it's trying to address an issue in the labor market that, to your point, the tech story is completely insulated from, but also not really, because they're sitting on so much cash as well. We can go into this for ages. That does it for the opening trade. Tune in tomorrow for a continuation of this conversation. The Pulse is up next. This is Bloomberg.